Most people think the smartest financial move is to pay off their house as fast as possible. They imagine freedom, no mortgage, no bank, no debt hanging over their head for decades. And every financial guru on the internet seems to repeat the same message. A paid-off house is the ultimate goal, so people stretch for the 15-year mortgage, higher payment, faster payoff, less interest, feels responsible, feels disciplined, feels safe. But there's a problem hiding underneath that advice. The math behind it is incomplete, because there's a difference between feeling wealthy and actually becoming wealthy. And once you see the difference, you'll never look at mortgages the same way again. Ethan believed the traditional advice completely. He bought a $500,000 home with 20% down. That left him with a $400,000 mortgage. He chose the 15-year loan at 5.8%. His monthly payment came out to roughly $3,330 before taxes and insurance. It was painful, but he told himself pain was part of building wealth. He skipped vacations, delayed upgrading his car, ate out less every month. Most of his income disappeared into that payment, but he felt proud every time he looked at the amortization schedule. The balance was falling fast. The interest savings looked massive. He believed he was winning. Sophia bought a nearly identical house 2 streets away. Same price, same down payment, same lender. But she chose the 30-year mortgage at 6.3%. Her monthly payment was closer to $2,475, about $855 less every month. Compared to Ethan, her friends thought she was making the less responsible choice. Even Ethan quietly judged her for it. She's going to drown in interest, he thought. But Sophia had a different goal. She didn't want the lowest interest bill. She wanted the highest net worth possible 30 years later. And those are not the same thing. At first, Ethan looked like the obvious winner. Every extra dollar he paid into the mortgage guaranteed a 5.8% return because every dollar reduced debt, charging him 5.8% interest. It was safe, predictable, risk-free. Meanwhile, Sophia still owed a huge amount on her loan after several years. The amortization on a 30-year mortgage moves slowly in the beginning. Most of the payment goes toward interest. Looking at the balance alone made her strategy seem foolish. But balance sheets don't tell the whole story. Cash flow does. And cash flow is where the story completely changes. See, Ethan's higher payment consumed almost all of the money he could have invested. Every month, his income was being redirected into home equity. That sounds smart until you understand what home equity actually is. It's trapped money, illiquid money. Wealth you can't easily use without borrowing against it or selling the house. Ethan was becoming house rich and cash poor at the same time. The internet celebrates this outcome constantly without realizing the trade-off being made underneath it. Sophia did something different with her lower payment. She automated the $855 monthly difference into a low-cost S&P 500 index fund, not manually, automatically, every month, same day. No decisions, no emotions, no timing the market. The transfer happened whether the market was up, down, crashing, or booming. She treated the investment like another bill that had to be paid. That single decision changed the entire trajectory of her wealth. Now let's run the numbers. After 15 years, Ethan's mortgage is completely paid off. He owns his home outright. Assuming the house appreciated at a modest 3% annually, it's now worth roughly $779,000. He feels incredible. No mortgage payment at 45 years old. The dream everyone talks about. Total interest paid over those 15 years was around $199,000. Painful, but far less than a 30-year mortgage would have cost. On paper, Ethan looks like the disciplined winner. Sophia's house is worth the same, $779,000 after 15 years. But she still owes roughly $295,000 on her mortgage. That sounds terrible until you look at the investment account. Investing $855 monthly at a 7% average annual return over 15 years resulted in approximately $270,000 invested. Suddenly, the gap between them becomes much smaller than people expect. Ethan's net position is roughly $779,000. Sophia's is roughly $754,000. After subtracting the remaining mortgage and adding investments, Ethan is technically ahead, but only barely. And this is where almost every mortgage debate stops. That's the mistake, because the finish line was never year 15. The loans were originally compared over a 30-year horizon. So let's keep going. From year 15 onward, Ethan no longer has a mortgage payment that frees up $3,330 per month. Finally, he starts investing heavily over the next 15 years, assuming the same 7% annual return. Investing $3,330 monthly grows into roughly $1 million. Add in the house value after 30 years, assuming 3% appreciation, and the home is now worth around $1.2 million. Ethan's total net worth at year 30 becomes roughly $2.2 million. That sounds incredible until you see Sophia's numbers. Sophia kept investing the $855 every month for the full 30 years while continuing her mortgage payments. But the magic wasn't just the contributions, it was the time. Her earliest investments had 30 full years to compound. By year 30, her investment account reached approximately $1.9 million. Her mortgage is finally paid off too. Her house is worth the same, $1.2 million. Total net worth, roughly $3.1 million. Sophia ends up nearly $900,000 ahead of Ethan. Same income, same house, same housing market, same starting point. The difference came entirely from understanding opportunity cost. That's the phrase almost nobody explains when talking about mortgages. Opportunity cost is what your money could have become if allocated differently. Ethan optimized for interest savings. Sophia optimized for long-term compounding. Those are completely different goals disguised as the same decision. And here's the uncomfortable truth. The obsession with paying off mortgages early often comes from emotion, not mathematics. People hate debt emotionally. They want certainty. They want the psychological relief of ownership. And there's nothing wrong with that. Emotion matters. Peace of mind matters. But emotional comfort and maximum wealth are rarely identical outcomes. The real power of the 30-year mortgage has almost nothing to do with lower payments. The real power is optionality. Optionality is one of the most underrated concepts in finance. A 30-year mortgage gives you flexibility. You can always pay extra if you want. You can accelerate the loan anytime, but you are not forced to. That distinction matters more than most people realize. A 15-year mortgage removes flexibility permanently. Once you sign, the higher payment becomes mandatory. Lose your job, payment stays the same. Medical emergency, same payment. Recession, same payment. Burnout, same payment. The bank does not care that life changed. Your required cash outflow remains fixed. Meanwhile, the 30-year borrower retains control. If income rises, they can invest more. If life becomes difficult, they can temporarily reduce investing without risking foreclosure. Flexibility itself has financial value, even though spreadsheets rarely capture it. Then there's inflation, which completely changes how mortgages work over long periods of time. Most people don't realize a fixed rate mortgage becomes easier every year inflation exists. That $2,475 payment feels large today, but after 20 years of inflation and wage growth, it feels dramatically smaller in real terms. Inflation quietly erodes the burden of fixed debt. The bank gets repaid with future dollars worth less than today's dollars. Long-term fixed debt can actually become an advantage during inflationary periods. The 15-year borrower experiences less of this benefit because they eliminate the debt too quickly. Ironically, the longer mortgage can become more attractive precisely because inflation exists. Now, this is where critics jump in and say, yeah, but most people won't actually invest the difference. And honestly, they're right. Most people fail this strategy completely. This is the part financial influencers rarely explain honestly. The mathematical advantage only exists if the investment difference actually gets invested consistently for decades. Otherwise, the 30-year mortgage simply becomes a tool for lifestyle inflation. Bigger vacations, more expensive cars, more shopping, better restaurants. The money disappears slowly and invisibly. That's exactly what happens to most people. The problem isn't the mortgage. The problem is human behavior. People overestimate their future discipline constantly. They think they'll invest later, start next year, wait until income rises. But wealth doesn't come from intentions. It comes from systems. That's why automation changes everything. Automation removes the need for motivation. Sophia didn't wake up every month deciding whether to invest. She made the decision once. Then technology handled the execution for decades. That's the hidden difference between average investors and wealthy investors. Wealthy people systemize good behavior, so emotions become irrelevant. Think about how mortgages already work. Nobody manually decides every month whether they feel like paying the mortgage. The payment is automatic. It leaves the account without discussion. That same logic can be applied to investing. Once investing becomes automatic, the entire behavioral advantage of the 15-year mortgage starts disappearing. This is why so many wealthy people intentionally keep low-interest mortgages even when they could pay them off tomorrow. It's not because they're irresponsible. It's because they understand leverage differently than most people do. To the average person, debt feels dangerous. To financially educated investors, low-cost fixed debt can be an asset if managed correctly. That statement makes many people uncomfortable because they were taught all debt is bad. But debt itself isn't the issue. Unproductive debt is the issue. Credit card debt at 24%. Interest destroys wealth because the interest rate exceeds realistic investment returns. A low fixed mortgage rate over 30 years is entirely different, especially when inflation and long-term market returns are considered. The stock market itself rewards patience more aggressively than almost anything else in finance. Most people dramatically underestimate how powerful long-term compounding becomes in later decades. The first 10 years feel slow. The next 10 years feel faster. The final 10 years feel explosive. That's because compounding eventually starts generating more growth than your contributions themselves. And this is exactly why Sophia eventually passes Ethan so dramatically. Her investments started compounding earlier. Time did most of the work. People love shortcuts in finance because waiting feels boring, but the market rewards duration more than brilliance. Starting earlier with smaller amounts often beats starting later with larger amounts. There's another hidden issue with aggressive mortgage payoff that nobody talks about enough. Concentration risk. For many families, their home already represents the majority of their net worth. By aggressively paying down the mortgage, they concentrate even more wealth into a single physical asset tied to one local housing market, one neighborhood, one economy, one property. That's not diversification, that's concentration. Meanwhile, broad index funds spread ownership across hundreds or thousands of companies globally: technology, healthcare, manufacturing, consumer goods, energy, finance, entire economies, entire industries. One strategy concentrates risk, the other distributes it. Now, none of this means paying off your mortgage early is stupid. It isn't. There are scenarios where it makes perfect sense. If someone struggles with financial discipline, the forced structure of a 15-year loan can absolutely protect them from lifestyle inflation. If someone values emotional certainty over maximum expected returns, that's valid too. Personal finance is personal, but what's dangerous is pretending the 15-year mortgage is mathematically superior in every situation. It isn't. In many cases, it's mathematically inferior, but behaviorally safer. That's a completely different argument, and understanding that distinction changes everything, because once you see it clearly, the conversation stops being about morality and starts being about optimization. The 15-year mortgage is not automatically the responsible choice. The 30-year mortgage is not automatically the reckless choice. The smarter strategy depends entirely on whether the person can automate investing consistently over decades. That's the real dividing line, not discipline. Systems. The people who build the most wealth usually don't rely on willpower. They rely on automation, structure, and time. They remove decision-making wherever possible because they know human emotions are unreliable. And this brings us to the biggest misunderstanding in personal finance. Most people think wealth comes from income. It doesn't. Wealth comes from the gap between cash inflow and cash outflow, multiplied by time and compounded returns. That's it. The mortgage debate is really just a debate about where your excess cash flow should go, into guaranteed debt reduction or into long-term productive assets. And historically, productive assets have won. Not every year, not every decade, but over long enough periods. Diversified equities have consistently outperformed fixed mortgage rates. That's why the hidden winner in this entire conversation isn't the person with the fastest payoff. It's the person with the most productive allocation of capital over time. Ethan optimized for certainty. Sophia optimized for growth. Both succeeded in different ways, but only one maximized wealth. And here's the irony nobody expects. By year 30, Sophia could pay cash for multiple houses if she wanted to. Ethan achieved emotional freedom earlier. Sophia achieved financial freedoms on a larger scale later. Both outcomes matter, but they are not equal financially. If you remember one thing from this entire discussion, remember this. A mortgage is not just debt, it's a cash flow decision. And cash flow decisions compound for decades. The internet loves simple rules because simple rules are easy to sell. Always pay off debt. Fast. Always avoid debt. Always. Buy a house. But real financial decisions are rarely that simple. The smartest path is usually hidden underneath trade-offs most people never calculate. The goal isn't to feel richest in year 5. The goal is to build the strongest balance sheet possible by year 30. And for people who can automate investing and leave it untouched. The math points somewhere most gurus never look, not toward the fastest payoff, but toward the longest compounding runway possible.